U.S. Secretary of Defense Pete Hegseth is in Japan. He's basically the American defense minister. He is in Japan and he has been sent by President Trump himself. Pete Hegseth's task is clear: prepare for war with China.
In news just coming in a tit-for-tat move, China has raised tariffs on U.S. goods to 125%.
Donald Trump says he is open to talks with Chinese President Xi Jinping after imposing an even higher tariff of 125% on China.
Investors and markets are trying to digest U.S. President Donald Trump's decision to suspend some tariffs while escalating a trade war with China.
Trump says he's open to sitting down with Chinese President Xi Jinping to talk things out. But his decision to escalate the trade war while also suspending some tariffs has investors and markets scrambling to figure out what's next. For a long time, U.S. Treasury bonds have been seen as the ultimate safe haven, the go-to spot for countries looking to park their foreign exchange reserves or protect their trade surpluses. It's why so many nations have loaded up on U.S. debt securities, trusting in the stability of the American economy to keep their money secure. But here's the flip side. This setup means the United States is leaning more and more on foreign cash to keep things running, tying its economy tightly to the decisions of other countries. With tensions flaring and tariffs flying, the big question is how this relationship might shift and what it could mean for the global economy. Who's holding the most U.S. debt right now? How does this dynamic play into the bigger picture of trade, wars, and geopolitical drama? And what happens if things go south? Let's break it all down and take a closer look at the countries with the biggest stakes in America's financial future and why this trade war could be a game changer for everyone involved. Now that we've set the stage with this escalating trade war, let's dig deeper into why U.S. Treasury bonds are such a big deal in this whole mess. For decades, these bonds have been seen as the gold standard of safety, often called risk-free by investors and central banks around the world. That reputation goes all the way back to the Bretton Woods system, set up after World War II, when the U.S. dollar became the global reserve currency. The idea was simple. The American economy was rock solid, so its bonds were a safe bet for anyone looking to store their cash, whether it was a country managing its trade surplus or a central bank handling foreign reserves. That trust has kept the system humming, with nations pouring their money into U.S. debt, because they know it's backed by a powerhouse economy that's not going anywhere. But here's where things get tricky. That trust isn't as ironclad as it used to be. The total stock of U.S. Treasury debt held by the public is expected to soar past $33 trillion by early 2025, and a massive chunk of that, about $7.5 trillion, is in the hands of foreign investors. The rest is held by folks and institutions inside the United States, like individuals, sovereign wealth funds, and even the Social Security Fund. While domestic savings help, the United States has leaned heavily on foreign buyers to finance its budget deficits, basically borrowing from the world to keep things running. That's kept interest rates low for a long time, thanks to the dollar's status as the go-to currency for global transactions. But with rising protectionism, ongoing trade wars, geopolitical tensions, and economic uncertainties, the cracks are starting to show. Countries like China and Japan, who hold the biggest shares of U.S. debt, are sparking debates about what might happen if they decide to scale back. It's a shaky moment, and the fear of a shift in this delicate balance is making everyone nervous about what's next for the global economy. Now that we've seen how crucial U.S. Treasury bonds are to the global economy, let's break down who's actually holding the biggest chunks of America's debt, starting with the top players. Foreign investors own about $7.5 trillion of U.S. debt, and the list of who's got the most is pretty fascinating. At the top, we've got Japan and China, two East Asian giants, Trungkwak, Haigun Konglo Zhongai, who've been in a bit of a race for the #1 spot, followed closely by the United Kingdom. These countries aren't just random investors. They've got their own reasons for holding so much American debt, and it's a mix of strategy, economics, and global politics. Japan takes the crown as the largest foreign holder, with around $1.9 trillion in U.S. bonds, though recent figures peg it closer to $1.09 trillion, sometimes climbing as high as $1.15 trillion. Japanese investors love these bonds because they're seen as a safe bet, especially in a world where Japan's own interest rates are super low. A lot of this comes down to the yen carry trade, where investors borrow in yen at low rates and invest in higher-yielding U.S. bonds. Plus, the Bank of Japan's monetary policies make it a smart move. The strong partnership between the United States and Japan also helps, keeping things stable. Next up is China, holding between $870 billion and $1 trillion, down from a peak of $1.3 trillion a few years back. China's been scaling back because of trade wars and efforts to diversify their reserves, but they've long used their export surplus to buy U.S. bonds, keeping their currency stable while giving the United States a big chunk of financing. The United Kingdom rounds out the top three with about $650 billion, thanks to London being a global financial hub where banks and funds from all over the world park their cash in U.S. bonds. It's a wild lineup, and each country's role tells us a lot about the global financial game. All right, we've covered the big players like Japan, China, and the UK, but let's keep rolling with the next set of countries that hold a serious chunk of US debt. And you might be surprised by who's on this list. We're diving into some European financial powerhouses that, despite their small size, are making a big impact in the world of US Treasury bonds. These nations might not have the massive economies of the top three, but their roles as global financial hubs make them key players in this high-stakes game of international finance. First up, we've got Luxembourg, a tiny country in the European Union that's holding an impressive $330 billion in US bonds as of early 2025. Don't let its size fool you. Luxembourg is a giant when it comes to finance, known for its favorable tax laws and regulatory setup that attract multinational companies and international funds. A lot of big players use Luxembourg as a base to manage their investments, which is why it's got such a hefty portfolio of US debt, way more than you'd expect for a country of its size. Right behind Luxembourg is Ireland, another European financial center, with around $320 billion in US bonds. Ireland's a go-to spot for major tech companies like Apple and Google, who channel their funds through the country thanks to its business-friendly environment. That's why the amount of US debt tied to Ireland is so high. It's often acting as a middleman for these global corporations to park their cash in safe assets like US Treasuries. Then there's Belgium, coming in with about $270 billion. Much like its neighbors, Belgium plays a big role because of its ties to EU institutions, the European Commission, international banks, and multinational companies that hold US bonds through Belgian accounts. These countries might not be the first ones you think of when it comes to global finance, but their financial systems make them heavy hitters in the world of US debt, showing just how interconnected the global economy really is. We've already checked out some of the heavy hitters in Europe, holding US debt, but let's keep going with the next batch of countries on this list, rounding out the top 10 and beyond. These nations might not have the biggest economies, but their roles in global finance make them key players in the US Treasury bond game. First up is Switzerland, coming in with around $250 billion in US bonds. When you think of global banking, Switzerland's name pops up right away, and for good reason. It's a hub for private banks, financial giants, and funds that see US debt as a safe place to park their cash. Next, we've got the Cayman Islands, an offshore finance hotspot holding about $240 billion. That number might seem high, but it's because a ton of hedge funds and management companies use the Caymans as a base, even if the real owners of those bonds are scattered across the globe. Moving on, Taiwan's on the list, with roughly $220 billion in US bonds. As a major economic and geopolitical partner of the United States, Taiwan's central bank and insurance funds have been snapping up these bonds to manage their trade surplus, making them a significant creditor. Then there's India, with about $210 billion, a reflection of its growing economy and efforts to diversify its foreign exchange reserves. India's been steadily investing in US paper to balance its portfolio as its global presence expands. Beyond the top 10, other countries like Brazil, Saudi Arabia, France, Germany, and Singapore each hold between $100 billion and $120 billion in US bonds, with their numbers shifting over time. Some nations like Mexico or Israel occasionally climb the ranks depending on the latest data. All told, foreign investors are sitting on about $7,500 billion of US debt, a massive piece of the puzzle. That shows just how interconnected the global financial system is, with Asian, European, and Middle Eastern players all holding a stake in America's economic future. All right, now that we've seen who's holding America's debt, let's talk about what could happen if one of these big players, especially China, decides to shake things up by selling off their US Treasury bonds. The United States has been able to borrow at super low interest rates for years, largely because the dollar's status as the world's reserve currency makes US bonds a go-to safe haven for global investors. Billions of dollars flow into these bonds every day, giving the US Treasury a steady stream of cheap financing to cover its massive budget deficits. But that setup comes with a catch. If major bondholders like China or Japan start unloading their holdings, it could throw the whole system into chaos, and that's where things get really dicey. This idea is often called the trade atomic bomb scenario, and for good reason. If China, which holds between $870 billion and $1 trillion in US bonds, decides to sell off a big chunk, it could send US interest rates soaring, mess with the federal budget, and slow down the entire economy. The ripple effects would be brutal. A weaker dollar could make imports pricier, driving up costs for everyday stuff like groceries and gas, while higher borrowing costs could squeeze businesses and consumers alike. But here's the twist. It's not just a one-way street. Selling off bonds would also hurt China and other sellers like Japan, since the value of their remaining bonds would drop, and a shrinking US market could hit their exports hard. It's a lose-lose situation, which is why no one's likely to dump everything at once. Still, even a smaller strategic sell-off could be enough to rattle markets and create fear, potentially pushing the United States to make political concessions or soften its stance at the negotiating table. That uncertainty is what makes this such a big deal every time trade tensions flare up between the United States and China. The question of whether China might play this card sends stock markets into a frenzy, leaving everyone on edge about what might happen next, with the potential for a trade atomic bomb hanging over us. Let's wrap things up by looking at how this whole situation is shaking up the markets and what it means for the future. Every time tensions between the United States and China flare up, the fear that China might sell its massive stash of U.S. Treasury bonds sends stock markets into a tailspin, and it's easy to see why. The top creditors we've talked about: Japan with around $1,090 billion, China with $870 billion to $1 trillion, the United Kingdom at $650 billion, Luxembourg with $330 billion, Ireland at $320 billion, Belgium holding $270 billion, Switzerland with $250 billion, the Cayman Islands at $240 billion, Taiwan with $220 billion, and India at $210 billion, together hold a staggering $7,500 billion of U.S. debt. That's about a quarter of America's total public debt, tying the U.S. economy tightly to the rest of the world in a way that makes every move a high-stakes game. This setup locks the United States into a delicate dance between foreign policy and economic stability. Some say these global giants can't afford to hurt each other, while others warn the cards could shift at any moment, especially if political tensions keep rising. What do you think? Could countries like China or Japan use their bond holdings as an economic weapon? Or does global interdependence make that too risky? How big of a wave would it create if they started selling? And what would that mean for the dollar, interest rates, and the global economy? I'd love to hear your take. So drop your thoughts in the comments, give this a like if you're hooked, and make sure to subscribe with the notification bell on so you don't miss what's next. We're keeping a close eye on this story, because even a small shift in these massive numbers could change everything, and we'll be here to break it down as it unfolds. Thanks for joining me. Let's catch up in the next one.